Hello and welcome everyone to another episode of the Investing with IBD podcast. It's Justin Nielsen here, your host, and it is September 4th, 2024. We've got quite a show for you today, and it's worth mentioning. For some of you, you might notice we're doing something a little different here. I tweeted out this morning that we are actually going live. This was something that we're trying out. We're going to be going live on Wednesdays, starting at 2 p.m. Pacific, 5 p.m. Eastern. So if you're a regular listener, you can actually get your information earlier now. So we will be live on YouTube. Something that we're going to try. We're still going to be posted on all of our usual channels afterwards. So if that time doesn't work out for you, never fear. We're still going to be there for you to watch whenever you get a chance, as your schedule dictates. But yeah, this is just something where we can talk kind of live and do something a little bit different because we're just having a lot of great success with our live content. So that's one of the exciting announcements I have for you. Another exciting announcement I have is Matt Caruso is back on the show. So president of Caruso Insights, president and founder, I should say, of Caruso Insights. Matt has a special place in my heart because the very first time I ever did the podcast as a solo host, Matt was my guest. And so, of course, I had a little bit of the nerves going and everything. But then after I got done, Matt, you made everything so easy. And so every time I have you on, it's like, oh, it reminds me of the first time. So great to have you on the show again, Matt. How are you?
Thanks for having me, Justin. And see, now it's something new again with the live, and I'm glad to be back and to get things tested with you. And
yeah, exactly. And I was telling Matt, look, I feel like he's the guinea pig. He, helps us out, tries things out for us. But if this doesn't work out, then I'm okay calling him the scapegoat. No shame there. So that's fine. But we got a lot to talk about here because this market really kind of threw folks for a loop. I mean, we had the start of August really kind of ugly for us last month. September, man, yesterday was no fun. On our swing trader status update, I called it the terrible, horrible, no good, very bad day, kind of likening it to the children's story. And it's going to be great to get your insights. And also, one of the things that I think is going to be interesting to talk to you about, Matt, is this idea of indicators. Everyone has kind of their favorite indicator, but you kind of notice that some indicators work better in certain markets than others. And so we'll talk about how you determine which indicators to use and when. But let's go ahead and pull up some charts and start with this market. Do you want to start with the S&P 500 or the NASDAQ?
Sure, we can go with the NASDAQ. I think it's probably the right one to take a look at.
It's definitely a little bit harsher. At least yesterday was.
Well, I mean, I think, Nvidia was the gift that kept giving, and now it's the stock that's taking a little bit. And I think we're just seeing that back and forth where it led for so long. And this concentration in large caps, I mean, was phenomenal for general indexes throughout, 2023 and 2024. Now that trend, I think, is leveling off. My opinion is I think we, at least in the intermediate term, of probably the leadership phase of Nvidia is passing. And so as you get that back and forth action, it's weighing on indexes. I mean, I think yesterday was the biggest single largest market cap drop for any one stock ever in history on Nvidia. So it was a big drop. And it's normal as, stocks, it's always stairs up, but it's the elevator down. And so we're seeing that a little bit here.
Yeah. And in some ways it felt like not only was this an elevator down, it was kind of like the elevator was missing and you just took took a drop. You didn't even have the elevator bringing you down floor to floor. You just kind of skipped some floors. So in terms of when you're analyzing the market, there's certainly the element of, the bottom up approach and looking at the stocks, and Nvidia is such a good gauge. I mean, for a while there, it seemed like as goes Nvidia, so goes the market. For a while there, it was Tesla was kind of the stock that gauged where the market was going. But in terms of the technical action, are there any levels that you're kind of looking at, moving average lines, things like that kind of really help provide guardrails for you?
I think instead of just looking at averages, what I'd like to do is really, and this year has been specifically a big outlier, like the spread between equal weights and the market cap weights have been so huge. So for the longest time, I mean, all year long, everyone's saying, hey, market's doing great. But that was really if either you were sitting in the market ETF or in those individual stocks that were running and running and running. But most stocks were not, it was a terrible market, but they just weren't running at the same pace or anywhere close to it. So I think we're starting to get that shift now where we're seeing some like the QQQ equal weight has been doing better. Even the kind of mid caps, MDY has been holding in a little bit better, which is a nice change of pace. We haven't broken out yet. I think in terms of levels, taking a look at something like the mid cap ETF, we've had this pullback. I think it was dragged down a little bit with Nvidia yesterday. We've been in this range. You can see even the pattern rec is showing it. It's been a really up and down range for the past several months. I think as long as we stay in this range, we're safe. We're nowhere near a kind of a bear market. But really, my focus, my hope with rates coming down and some rotations out of maybe the mega caps is that, the mid caps, small caps are kind of just pausing here at their highs. And as soon as Nvidia catches his breath from falling, they'll be able to push out to new highs and they'll take that leadership torch.
Mm-hmm. So one of the things that I think was very notable, and this is something that we've been talking about for a while here, is that July 11th, this was a CPI report that came out, and it really kind of seemed to change the market temporarily, where mid caps all of a sudden were all a flutter. IWM, the Russell 2000, small caps, huge move there, and this also coincided, back to your point on Nvidia. Nvidia had actually kind of topped a little bit before that with this downside reversal, was trying to get back to new highs, and then had another downside reversal. And the NASDAQ, also, had this kind of ugly day right here on July 11th. So it really kind of seemed like there was a change happening. But then again, getting back to the small caps, you had this kind of come down just as hard as everything else on those 3 days, starting August 1st through August 5th. And it just seemed like it was kind of back to the old guys, the old guard, and small caps seem to lag a little bit. You see that with the relative strength. And so it almost felt like there was a rotation in play. Then people were like, no, wait a minute, let's go back to the other ones. And now it seems like they're going back. So is this like an indecisive market? Is this kind of a function of summer? What do you kind of attribute all of this rotation to?
I think there's two important elements that's driving all of this. So, obviously inflation in the past few years has impacted all of us, like in daily life. But in terms of markets, we haven't really seen anything to this severity unless you went back to the 70s. I mean, I didn't live through it myself, so you have to go back and study all of that. But a lot of the relationships were really different during that inflationary period. Like it really threw a loop, like, a lot of the standard relationships between markets. So one thing, for example, is as soon as inflation kind of peaked back in the 70s, started to trend lower, markets bottomed and they started to take off. This cycle here, because of that inflation, it really increased the disparity between the haves and have-nots in the market. So, if you look at the mega cap tech stocks, not only were they kind of a place of safety because they were liquid, not only were they a place of safety because they had a big market cap, they had a huge customer base, they also had, lower financing costs. They could borrow at better rates. So like everything was working in their direction. Usually most cycles, that spread between large and small is not as big. So I think going into really at the end of last year, the end of 2023, we really started to see that broad-based move in November, December, and then we got kind of that sticky inflation beginning of this year. I don't know if you remember that, kind of like things were picking back up, concerns came back. So I think it's really been the story, and we, as stock investors, we tend to always look at stocks first, but I think it's really been a bond story that's causing all these relationships under the surface that people aren't noticing. And with that, if you sprinkle on like the modern algorithms where the longest time they do what works, right? It was, be long, large cap tech, short, small caps. And everyone, when they get too positioned in one trade, that everyone running for the door at the same time causes these very fast dislocations. So I think like all of that in and out, it looks so confusing, but I think it's really, if you look at it from the big picture and you kind of understand what's driving it, which is bonds and inflation, these rotations, sprinkle in algorithmic trading, and it starts to make sense. So I think we're back at maybe a turning point like we were last fall. It was put on hold, I think, because inflation came back up. But should that finally, go to rest and the economy holds in there, I think we get back to more of a normal bull market where most stocks go up and with broader participation.
Yeah. And that's kind of what seemed like was happening for a little while there.
Yeah.
It seemed like we were finally getting the small caps going up. Again, we had what we call a follow through day on August 13th. And it just seemed like you had the S&P 500 going up, the NASDAQ going up, the Dow Jones Industrial Average going up, the small caps going up, the mid caps going up. It was like everyone's participating, and then again, it just seemed like the rug kind of got swept out from under you. Now, you mentioned bonds, and it brings up a few things. So I've got kind of 3 points that I want to throw at you. You can decide which order you want to take them in. So number one, we got to talk a little bit about the inverted yield curve. It almost went uninverted today at the close.
Yeah.
So we have kind of the longest. You mentioned the 70s, and this is from Dow Jones data. Some of the folks there at Dow Jones were saying this is the longest streak since 1978 to 1980, where the yield curve of the 2-year and 10-year has been inverted. So we're at 544 days right now. Started July 1st, 2022. Almost got there. It's gotten there a few times intraday to uninverted, but didn't make it at the close today. So we're at this very long streak, and this data goes back to 1977, I should add. So the inverted yield curve going uninverted or getting close to it, that's one thing. Let's talk a little bit about Bostic today, the Atlanta Fed president, who is a voting member, typically known for his hawkishness. He was saying, look, we don't have to wait for 2%, or we can't wait until 2% inflation target is reached before we make cuts. And then also just the whole idea of cutting in general, where it almost feels like, is the market going to have a temper tantrum if we don't get 50 basis points this month? It seems like more and more, especially after the JOLTS report today. There was kind of a quick little jiggle as the JOLTS report missed estimates, lower than expected, and it seemed like the odds of kind of spiked up to like 50% or something of a 50 basis point cut. Now, I want to say that those Fed futures have been off the mark for a while. I mean, they've been, according to the Fed futures, we got cuts coming like last year, and they didn't materialize. And then it was 7 cuts this year, which not going to happen. So what is kind of your take on those 3 topics? Take whichever one you want.
Well, so, you speak of, like the data points going back to the late 70s, and that's really to my point. It's the inflationary playbook. So I know some people also kind of point to recently, as soon as the Fed started cutting, such as 07, 08, it led to a big crash because they were late, they were behind the curve. That was really driven by many under the surface problems. Maybe the Fed wasn't aware of. They're just too late, or they didn't realize the intensity of it all, of how big it would be. But again, if you go back to like the 70s and the rest, when the Fed started cutting rates, markets really lifted off. And if you take a look at what stocks are leading now and how you're getting better breadth, and you're seeing interest rate sensitive stocks lifting, it's interesting. There's a lot of this action that's, in my opinion, still typical of early stages of a bull market, that what you typically see. So like a lot of the stuff that you usually see early bull market hasn't materialized, because I think the AI trade and the mega caps like just took all of that flow of capital. So whereas I think some people can look at it as a little bit more as a worry that, the Fed's going to be cutting rates. In the past, sometimes it's led to a peak. I think you have to always look at it in context of what the reason is that in past times that led to a decline. So the way I'm trying to position is, I'm always a growth investor first, but there's some trades that I'm looking at. For example, if we expect both inflation to come down and interest rates to come down, that means real interest rates. So interest rates adjusted for inflation should really drop off. So and to what Bostic said today, the Fed's restrictive right now. I mean, their rates, if you look versus the 2-year yield, the Fed is maybe starting to become late to cut here, I think, if they want to listen to what the market thinks. So there's some groups, and you can see like gold has been very strong. And what's interesting about gold is we're sitting at highs. If you were to compare gold to like an inflation adjusted bond, usually there's that very strong correlation. If you bring up like GTIP, which is like the Goldman Sachs like tip bond, it's not a great looking chart, but the way in my MarketSmith, the way it comes up, but typically, because it's not a very high volatile type of stock.
Yeah, it's pretty flat looking, right?
Maybe if you put a daily chart, you'll see it'll look a little bit better.
Yeah. So it's the logarithmic scale, of course, that does that, kind of, flattens it out. But on the arithmetic scale, which we do have on the daily.
So typically this is very correlated with gold. And so it's interesting that this is putting in, if the chart was larger, a really big head and shoulders bottom, which if this goes up means that, real interest rates are falling. That should really support gold. That should really support companies that are high growth because, they're dependent on capital. They're not, big earnings drivers right now. Most of their earnings are in the future. So it always helps when rates are falling for those kind of companies. So it makes sense if we are at that inflection point, whereas people think the bull market's over just because looking at what the indexes have done. Yeah, because the large caps have led. But I think if like GTIP can break away and start to rally, you're going to start to get more of that classic acting bull market where it's small, mids, high growth, those kind of stocks that are really lifting off and leading the charge versus just the Mag 7.
Mm-hmm. So, I mean, that kind of gives us a good sense of your expectations for the market. Mm-hmm. So if we can kind of switch gears, because to a large degree, it feels like every market has its kind of differences, right? It's like, I remember in 2018, we focused so much as growth investors sometimes on the earnings. And it was like, the market doesn't care about earnings. That's, that's so, a decade ago. It was all about the sales and the huge increases in sales and everything like that. And look, we saw sometimes where people say, oh, it's the new economy, like, famous last words of, 1999 and 2000, where, business plans don't matter. You just throw .com at your, at the end of your name, and that's your business plan. So there's all these indicators sometimes that people can look at. And sometimes it's hard to figure out, where do I go? Which indicator should I use now? Because this indicator is best for this type of environment. This indicator is best for this type of environment. So how do you kind of cut through, the noise, really? Because there's all these different indicators you have available to you. How do you figure out which ones to use?
So to the discussion we had before, every cycle, there's some kind of different driver, right? So this time around with inflation, the rest, earnings were more important than other cycles. When rates were at 0%, I mean, who cares if earnings are 5 years from now? There's no cost for interest anyways. We'll just sit and we'll wait. So that it changes based on cycle. And that's what can get confusing sometimes. Because, if you look at just the past, let's say, the whole COVID bull market, all the stocks that took off were just anything that had top line growth, and it was all about the new trends. And so each cycle, you need to adapt. Now, there's always every cycle going to be some stocks that are true to form. Let's say you want stocks with earnings. You'll always find a couple of stocks that lead. But if you really want to nail a market cycle, it always helps to understand what investors are focusing on. And it may not seem like it makes a lot of sense that their preferences would shift. But again, because of the economic dynamics, it does cause a shift in preferences. So if that's why I think relative strength as a tool is the most important tool, because it really helps you to look at all the data that's coming in, say, okay, these are the data points we know are important. We're always trying to figure out which companies are growing sustainably, what investors are willing to pay. But at the end of the day, those that are leading in the market are the ones that are being rewarded by investors right now in this cycle.
Yeah.
So as you're looking at all these different stocks and these potential stocks, again, this is always shifting. If you can always kind of have that checklist and be like, okay, are they at least showing relative strength? If yes, it soon starts to become apparent that, hey, they're rewarding either large cap, or they're rewarding small cap, or they're rewarding high top line growth or earnings growth. So that relative strength is really the important way to kind of double check what the theme is this cycle.
Yeah. And what I like about that approach, because I couldn't agree more, but what I like about that approach is, sometimes you don't know, it's not obvious until after the fact, right? It's, so your signal is kind of like, okay, this is telling you where the money is going. Now you can kind of build a thesis as to why, but, look at what's happening first, and react to that before you start coming up with the why it shouldn't or why it should, or, because again, you can rationalize yourself out of anything. And I often use the point that, look, you can give me some of these headlines ahead of time and it wouldn't help me. The chart helps me, but the headline doesn't, because I would think it would do something completely different. So Matt, you kind of came up with your own little twist on relative strength. So I've got the Nvidia chart up, and this is from Caruso Insights. Explain a little bit about what we're looking at. I mean, everyone knows kind of what's happening with the price, but you have these blue shaded areas. And for people that are maybe listening to this, you might want to go to the video and kind of check this out. Again, for those listening to the archive, and you can find that at www.investors.com/podcast. Or of course, you can go to the YouTube, check out check out Matt's thing. You can find it on our Twitter handles and everything like that. But Matt, could you explain what we're looking at here in as much detail as you can?
This came up to me when I was a market maker early in my career, and a lot of stocks I worked with were precious metal stocks. So gold stocks are interesting because gold itself is probably one of the least volatile instruments on the market, whereas gold stocks are probably one of the most volatile instruments on the market. So if you just kind of looked at any up cycle, anytime gold went up, on the way up, gold stocks will always outperform gold on a percentage basis, and on the way down, they'll always underperform. So trying to run a regular relative strength analysis never really gave me that good kind of information. So what I started to kind of do every day was say, okay, what is the typical volatility for these stocks that I'm tracking? And I'd watch them very closely. And so if gold was down on the day and the stock should, let's say, fall 3%, but only fell 1%, I say, oh, this is interesting. It should have fallen a lot more given how volatile it was. So by studying that sector and that weird spread between the stocks and the asset, it gave me that interesting insight. So I kind of took that a step further, and really it comes down to kind of studying alpha instead of just relative strength. So basically you take the stock and you look at how it's related to the index, and you also adjust it for how volatile it is, how jumpy it is. Mm-hmm. And what I do is I look at a few different time frames. I like to look at between 3 to 6 months to have a more recent reading. But the blue shaded area is basically when there's like a critical threshold is passed, where based on its relationship to the index and its volatility, is it outperforming based on its temperament? If that's the case, have a blue shaded background. If not, I don't. So if you look at Nvidia here, interestingly, you can see in January, it started to turn blue background. It had a great run up. Even though we're still pretty close to the highs as of now, this bad break is kind of telling us like, hey, given Nvidia's relationship to the market and volatility, this is a bad break. So it's kind of lost that leadership role right now. Whereas a traditional ranking tool like an RS, which just looks at percentage returns over the past 12 months, Nvidia still looks great. So this is kind of an interesting tool where it adjusts for the specific nature of the individual stocks.
Mm-hmm. And so you're using kind of a comparative as what's your bogey? What is your comparison that you're using? Because you mentioned gold versus gold stocks. Are you getting that minute, or are you going broad, just S&P 500?
So by default, I found, interestingly enough, I even found that I studied the same gold stocks versus the S&P. It seems to be whoever's outperforming the S&P is really getting like the money flow. So if you're a really niche investor and you say, I just invest in gold stocks or in oil stocks or whatever, you can change the point of reference. You can say, I'm going to compare just to gold. But by default, I still always like to refer against the S&P 500. That's the default index everyone's watching. And that really helps to show where the big money is really rotating to.
Mm-hmm. And why do you use beta, for instance? Because there's a lot of different measures of volatility. If you want to get into the options market, you can look at implied volatility, looking forward. You can look at historical volatility, which people usually use standard deviation. You can look at, some people like to look at the ATR, the average true range, over a certain number of periods to kind of say, oh, this is how much this stock tends to move. Why beta?
Because beta has kind of two components to it. It looks at both the volatility of the stock, but it also looks at how much it's related to the index you're comparing it to. So for example, let's say you look at a telecom company. It may have low volatility. So an ATR, average true range, or any kind of historical volatility would also kind of bring you to that conclusion. But it may not be very correlated with the index. So by kind of measuring it versus the S&P, but using both those components, you really get interesting insights. So you just brought up BCE, which is a Canadian telecom company, and they have a really high yield. I think at their lows, it was like a 9% interest rate yield, dividend yield, which sounds crazy. But I mean, they're I think probably the largest telecom in the country. So they're a sizable player with that yield. And you can see they've underperformed the entire cycle.
And before people, start saying blame Canada or, bad things about Canada, Matt is, he's in Canada right now. So it's keep your comments very, very friendly. Okay. to our Canadian neighbor. So this is a large telecom.
So large telecom, high dividend yield. This has just been completely out of favor because, with rates going up, if you can get 5% with the government, why take the risk of an individual stock? And that's what's led to this dislocation. But it's interesting. You can see that coming off of the bottom, even in this chart here, if you look at last fall, you saw there was a rally from, October into January, but the blue background never came on because the S&P was still pretty strong during that period. However, if you look at right now, coming off the bottom, we're starting to get the initial signs that, hey, we're starting to outperform here. I mean, a traditional chartist would look at this and be like, whoa, this is still in a strong downtrend, but there are signs that we're improving on a relative basis for this stock's volatility versus the S&P. So this, when going through a lot of charts, especially at turning points in the market where Nvidia has been the clear, dominant king of this market, and you're looking at this and you're saying, hey, this is fallen out, and who's falling into relative strength, and it starts to kind of, again, like we said, figuring out for the new cycle. It seems like every 3 to 6 months there's a new kind of cycle that will take investors' attention. You help to kind of build that thesis, like you said, like, okay, well, what's driving? Is it more interest rate sensitive stocks? Is the market finally pricing in rate cuts for real again? They dialed it back earlier in the year. If that's the case, it's going to lead to new winners. This is maybe a value type of play, but again, going to even individual growth stocks, you'll start to see that, hey, wow, this is really kind of hitting new groups that weren't participating before.
Well, and to your point, sometimes that can let you know. Growth isn't being favored, value's being favored. A lot of times on our general markets page, for folks that aren't aware of this, we have our general markets indicators page, and two graphics that Bill used to really like to look at. One was basically growth versus value. He used a simple growth fund versus a value fund. When the line was going up, growth was outperforming. When the line was going down, value was outperforming. Or you could also do that with big caps versus small caps. It kind of gives you that sense, because again, at the end of the day, a relative strength really is just a ratio, right? It's just, this number over this number, which one, if it's going up, the top number is outperforming, and, opposite the other way. Talk to me a little bit about, like, especially on BCE, this seems like it had these short blips, recently, a short blip, and then, not quite, a short blip, not quite. Now we're in another one of these blue shaded areas. How do you how long is enough time to say, oh, this is really catching on now, as opposed to, oh, you had one bad day, people kind of like were scared a little bit, or a few bad days, they went defensive. How do you know it's a real trend? How many days, I guess?
Yeah, so that's why this tool looks at, like, both kind of 1 month readings as well as 6 month readings. So it's a blend of time frames. But another way I like to use it as well, to kind of get again, is the theme broader, or is it just one stock story? If you bring up the chart, AMT, which is an American provider of antennas and all the other kind of telecom infrastructure, if you can start seeing it, that those kind of turns happening in other stocks in the group as well, so say, oh, I think there's a little more of a broader stock group move here than just one individual stock. So that's the nice thing, kind of being able to compare different stocks within the same group will bring also different insights as well, instead of just looking at the stock by itself.
And, to your point, like, in terms of one of these areas that does seem to be favored right now, REITs are a big area. XLRE, if you look at the sector spider funds, or one of the things we did with David Ryan today on IBD Live is he was just like, okay, look at the market surge growth 250 and percent off high, and the stocks that were the least off their highs, filled with REITs, filled with financial specialty, filled with insurance, filled with utilities, electric power. So those, there's just a lot of different ways to come at this in terms of what's holding up best. That's one way. I think this is another great way of doing it, kind of, again, making that adjustment. You can use market search charts and look at the relative strength line. Again, a very simple ratio. You can put moving averages on them. So there's a lot of different ways to come at this. But at the end of the day, once you figure out, okay, something's happening, then what? What's your next step? How do you use this information to, again, does this kind of go to that bottom up approach? You say, okay, here are the areas that I'm noticing that are moving, the money's flowing to them. This is my list. Or, I mean, if you're a growth investor and growth isn't working, you just say, okay, I'm going to stay in cash for now.
I think that comes down to, again, Bill's methodology, which is always rings true, is you have to find the leader of the cycle, no matter what it is. So, last cycle was Nvidia. This time around, we're seeing these different stocks kind of move higher. And, who's the leader of this cycle? Even if there is this trend taking off, it's interesting, even looking at, like, all the, the REITs and the rest of the stocks we're looking at, like you mentioned, it brings out, I think, what is like a key principle of the market. It doesn't matter what you did in the past. It's all about what's coming next. So,
Yeah.
earnings and sales are always a great tool to see. It's kind of like a, your track record, right? A company's track record. And it's just a way to figure out, are you going to keep being this winner? If you've done it before, chances are you'll do it again. But at turning points sometimes, and usually driven by bonds, because bonds are, have a big impact on so many stocks and their earnings. Sometimes, by the time these cyclicals, by the time they have great earnings, the move is over, because then after they're priced fully back to normal. So at these turns, sometimes you're seeing these REITs and different companies, and you're saying you can't understand. They don't have great numbers yet. What's going on? It's investors anticipating that falling interest rates are going to, boost their earnings in the future. It's also going to make them more attractive as their dividend yields relative to interest rates are going to be higher. And so those are some key themes. Now you can take it a step further and say, okay, well, I don't want to just invest in a utility. Who's growing that has big growth numbers that's in that theme? Who's exploiting that theme and also has a long-term kind of secular growth trend that's benefiting? So if you're talking utilities, those utilities, towards energy generation that's going to support AI growth, right. That's a way you can kind of tie in two themes together to try and find true leaders versus just a beaten up stock that's bouncing off the bottom. So really kind of building this mosaic picture, looking at different things that maybe at first glance aren't related, but trying to kind of build that thesis with all these different data points. If you can catch on early in the trend, what's going on, then that really allows you to get to those key leaders, which is, again, looking at NVIDIA in the past year, all you had to do was be in NVIDIA and you had a good ride.
Right. So, to that point, one of the things you and I were talking about earlier is, again, when you're kind of approaching this theme, thematic approach, you kind of were likening this back to the heyday of the internet, right? The 1990s, where you did have a lot of this infrastructure starting things out. What was it? Ascend with the switches, Cisco, with the networking capabilities. And then now after that, you got kind of the consumer products like Yahoo and AOL and, and the search engines. At one point, remember, it was all about Yahoo and Ask Jeeves.
That's right.
And,
I remember that.
Yeah, things like that. And again, you never know sometimes who is going to be the winner of some of these.
Yeah.
Qualcomm was by far and away the chip leader because of what they were doing in phones. And you just sometimes don't know. So I guess there's that balancing act of being early enough to kind of catch the majority of the trend, but not being too early to where it's not apparent who's going to lead or what's going to lead. Sometimes it's a little bit of a mismatch as people are trying to figure out the theme still. So how do you kind of learn from that past experience in the 90s and apply it to something like AI today?
I think we're fortunate because if you were in trading in the 90s, there wasn't a perfect parallel, like a growth industry that was going to grow that fast. So we can look back at the internet, and what you had was the initial infrastructure wave that then led to consumer products, like you mentioned, like the Yahoos and the rest. And then you also had a secondary infrastructure wave, like Qualcomm. You mentioned that they only had their big move like way late in the 90s.
Yeah.
And also, originally, Cisco was the big winner, but late on, you had like Lucent, Nortel networks where Ethernet, people demanded faster internet. So looking at the current cycle, NVIDIA has been that initial leader, but if you get too fixated on the leader from one part of the cycle, sometimes the opportunity for that leader gets fully priced in, and then there's these new upstarts that come around that have these incredible advances. So I think we had wave one, even with NVIDIA. I think there was news recently about antitrust and all the rest. So it's kind of, you get so big so fast and you run into some other different issues, but there's always going to be someone who's new, who's coming to the market, who's going to provide a new angle to make the chips even faster. Or what I think is the next stage is we're going to start to see the fruits of all of this massive CapEx. So, you're looking at companies like Tesla, where Musk is deploying these AI clusters. Yeah, NVIDIA benefited now because he bought all of these thousands of chips from them. But at the end of the day, if you can't turn all that into a profit, NVIDIA won't keep selling those chips. So, someone's going to be generating some incredible products, and that's going to create a whole new wave of opportunity. So we need to be, we can't just get too fixated on one leader, because as that theme unfolds, if you look at the 90s, there's always, each person will build on the person that came before. Right. And, Joe Fahmy's been on the show often. I always like to listen to what Joe says. And And he talks about how nowadays investor sentiment shifts faster than before. I
Mhm.
feel also, again, with AI and all the rest, technology grows or changes a lot faster than it did before. So maybe saying that the internet was a 10, 12-year rollout, we're probably going to see a lot faster, rapid change going on to new names than we did in the 90s as well. So I think it's going to be really interesting the next few years.
Mhm. Yeah, and to that point, I mean, there were so many in 2021, right? There were all these IPOs, SPACs, the special purpose acquisition companies, and then 2022, that spigot dried up. It
Yeah.
was like nothing. And it did remind me of, the internet kind of thing where you
Yeah.
saw the late 90s, everyone was coming out with an IPO and again slapping .com on their name, and that was their business plan, and then nothing. It was just like
Mhm.
this desert, IPO desert for a while. So um how closely are you watching that IPO market as kind of like, oh, now the next wave is kind of starting?
Yeah, I'm watching that closely, and I'm also watching what companies that are a little bit larger. Because if you look at all the, Nvidia and all the leaders so far are the biggest market caps of the market. There's going to be
Yeah.
rotation to new names. IPO market's going to be really interesting because it's been so quiet. But at the same time, the money that's going to rotate out of Nvidia won't necessarily want to rotate into a very small cap or micro cap, IPO type of opportunity. So I think trying to look at who the key winners are going to be that have more substantial market caps, I think that's probably going to be the next wave. Because even from a consumer perspective and an investor perspective, there's that trust factor. People have to feel like, okay, we're actually going to get something for this capex. This person's actually able to come to market with a product that's going to be a real earnings driver in the future. So I'm looking at, I think Elon Musk, again, even something like the robo taxi, which he's going to unveil or supposed to unveil October 10th, that's really an AI problem. And
Mhm.
if there's anyone who has kind of that finger on the pulse of future tech, I mean, I think Musk is someone who could possibly solve that.
Mhm.
It's a lot of what ifs because the products are not around yet, but AI is moving at such a breakneck pace. Um, you have to kind of start to anticipate, who could really be the big winners. And I think robotaxi could be one. Uber could also benefit. They recently signed a deal where they're going to be with GM as one of the places where people can kind of hire these autonomous vehicles to pick them up or whatnot. There's some other, some small upstarts like Serve, SCRV. They have like these kind of last mile little delivery robotic type vehicles. There's a lot of different kind of interesting ways these real world AI is going to start to come into play. But I think Musk is probably going to be the first one that's going to be big, liquid, and an opportunity for scale that people are going
Mhm.
to be looking at. So I think that October 10th is going to be really important to see how this AI is coming to fruition in the real world instead of just in theory.
Mhm. So let's dive a little bit more into the stocks, and I think it's again such an interesting point that you're making here, because I mean I think back to again if we use the 90s as an example, it was very different then because you had your market cap leaders were things like ExxonMobil.
Yeah.
Right? I mean, it was
Yeah.
it's hard to it's I saw this I don't know where I saw it, but it was really interesting. It was kind of like your market cap leaders, your top 10 or 15 or something like that over time. And I was stunned to see how many of the market cap leaders in the 90s. I mean, it was a while before you had like the IBM, the Intel, and again, like the Dow Jones Industrial Average, even sometimes it's kind of late to the game in terms of, oh, we'll add you on, and it's like, oh, okay, well, yeah, after the move is done.
Yeah.
Yeah, but let's talk about a little bit more of the stocks. I mean, you mentioned Tesla already, and
Mhm.
I gotta say, like there are certainly some of the things like even with SpaceX, where when I first saw that like Falcon 9 like land, I was like, I got goosebumps. It was like, oh my gosh, how does this change things going forward? And I think some people were thinking of that with AI, the Chat GPT, and starting to think of, oh, what kind of different things can I do with this? And
Mhm.
seeing some of the my daughter's going to college, and I'm thinking of some of the ways in which she can use AI to study that are so.
Mhm.
I mean, she can just hit record on a lecture, have AI come up with a whole study guide for her,
Yeah.
flashcards, all of these different things. It's just, I mean, sometimes I think unfair, I wish I had that, but,
Yeah.
so back to Tesla a little bit. So
Mhm.
I guess part of the problem sometimes is the story can be so enticing.
Mhm.
It's sometimes I get sucked in. It's like, oh, this is amazing. I mean, I was a big sci-fi fan when I was little. I read Heinlein and Asimov, and I loved Back to the Future when they go to 2015 and it's like, oh my gosh, look at how the future is, so cool and stuff. How do you kind of separate the story between, oh, it's really happening, the investors are rewarding this, and it's not just hype?
Well, first of all, I know something, obviously just hype alone is a negative. You have to produce something. But if you look at every cycle, the really big movers are always stocks that's somewhat kind of capture the imagination of people for good or for bad. Like in the let's say going back to the 1970s, it was really worried about OPEC and gas lines, and that was what was on people's minds. Or the 90s, the internet. I mean, it was the computers, like a computer. It was really dramatic kind of stuff. So I think AI and looking at things like an autonomous vehicle does capture the imagination, and it has incredible real world applications. But you can't just fall for hype. It's important. So that I think relative strength plays a part of a role, but I think this is also where you have to understand what management is. You have to hear what they're articulating. If they can't really show a path to profitability,
Yeah.
it's probably a stock that's going to have a quick run and then drop. I mean, the reason Nvidia, went up so far and has retained its gains to date, or got, companies like Microsoft and the rest, is because they've delivered those earnings eventually.
Mhm.
So, that's I think where you have to
Not only
decide as
delivered, but like went way beyond, like
right, right.
smashed
Yeah.
expectations.
If you look at Apple early, like 2003 with iPod, it was a new invention. Like no one knew iPhone was going to come around, and iPad and all this
Yeah.
kind of stuff. So at first it was really okay. We can see how music can be changed, and we can, instead of a CD, be in a a hard drive device basically. And then after, but Steve Jobs was able to kind of do it at scale profitably. So again, having your pulse on what key themes could be. Sometimes the move is enough, it's substantial enough where, hey, maybe they never get to profitability, but it's still a 200% move, and that's still a good enough of a trade. Depends your wheelhouse. But I think if you're more concerned, this is where again you can use relative strength to find different winners. And I think another interesting stock is GE Vernova, which is an energy generation company. There was a recent split. GE recently split into three companies.
Right.
And I think that they're the highest growth company of the three. And they're just focused on electricity generation. They have the oil gas segment, they have renewables, and they also have small modular reactors, which is nuclear. So they basically whatever segment is going to win in the future, they have a hand in it already.
Mhm.
And they're already profitable. They have big earnings growth coming down the pipe. And I just love a company. This goes back to the book "You Could Be a Stock Market Genius Too" by Joel Greenblatt, where he talks about how spinoffs are a great sign that management cares about shareholders.
Yeah.
Most CEOs just want a bigger company to manage. If they went out of their way to break up a company and have a smaller kingdom to rule over, it's because they really think it's in the best interest of what the stocks can do. So GE splitting into three gives it more focus. It's a young stock. You have, I think, a lot of flows are going to come its way. I think I was upgraded today by Jefferies, if I'm not mistaken.
Mhm.
And I think there's a great way you can play AI as a theme in regards to it's just going to be more and more electricity generation, whether it's Musk that pulls it off, whether it's Nvidia selling more chips or whatever it is. If AI is going to be what people think it will turn into, we're going to need more electricity. And so I think GE Vernova is an interesting way you can focus on earnings and still be in that trend.
Mhm. Yeah, it's interesting that you say that, because I feel like for a while there, spinoffs were kind of given a short shrift, because it was kind of like, oh, you're really trying to get rid of the junky stuff, and it's like, okay, this is just, will look better if we get rid of some of this junky stuff. But in the case of GE, it really was kind of like, these are such, I mean, GE was so many things. I mean, it was in
Mhm.
diversified operations because it had jet jet engines. It had NBC. It had light bulbs. It had, like, all these different things. And now it's kind of like, oh, you can kind of understand a little bit more, like, oh, this is what this company does,
Mhm.
instead of like, oh, it just does a little bit of everything.
Yeah.
But to that end, M 3M seems like it's kind of taking a page from the
That's right.
the playbook of GE, and it just recently did a spinoff. I do have a position in 3M myself, and yeah, it is interesting to see how this kind of plays out from, oh, let's consolidate and get as big as possible. And now there is some of these concerns, as you mentioned, with Nvidia, antitrust, Google antitrust.
Right.
Is there kind of another wave of, hey, you guys are getting too big, and if you don't break yourselves up, someone else will, kind of thing. I'm thinking of back in Theodore Roosevelt's days with the with a stick, but
well, going back to the original trust that was broken, which was Standard Oil. I mean, it was the big initial case, and when those companies were broken up, all the big oils we know today were all Standard Oil originally.
Yeah.
And once they were broken up, they were much more valuable if you added them all up, broken up, than when they were conglomerates. So that really unlocked a lot of value. That was kind of one of the first case studies of how that worked out. And so, I mean, but whether it's Nvidia, whether they're broken up, whether it's not that it's going to happen tomorrow or anything, but whether AMD comes up with a competing chip or if the end result is more electricity generation because AI is really solving real world problems, then someone like GEV has the opportunity to supply that electricity, and you should get continued earnings growth over the coming years. So I think GEV is an interesting way to play both a move into utilities and that more secular AI theme.
Yeah. One more stock to cover, and you know what? I really appreciate the folks that did join us live. There's a few names that I recognize, from our IBD live crew. Some regulars there. Some people giving comments about looking at Dan Ives, saying that, hey, the AI theme. Dan Ives saying it's bottom of the first, top of the second inning. That's a lot of game left to play here. Folks mentioning your point about the monetization. I mean, let's think about Meta. Someone brought up Facebook, and this is an example we've used before. But if you go back to the original IPO here, it was an ugly start. From the IPO, even though they had such market share, it didn't matter until right here. Oh, guess what? We know how to monetize this now.
Right.
And that kind of changed everything. So kind of a big AI name is Palantir, PLTR. And to your earlier point about volatility, I mean, this, Palantir, I've played it a few times and I have not done well because the volatility a lot of times shakes me out. If I buy it on a pullback, I do much better. If I buy it on a breakout, I'm toast. It's not going to happen because the volatility just shakes me out. So what is it about Palantir that you like?
So to your point about volatility, sometimes you come to market and the valuation is just so excessive, kind of like a Meta. It just takes time for that to catch up and as new tailwinds build. But if you look at what Palantir has been doing, they partnered with the UK's health system, a lot of other hospitals. The way they've been able to reduce wait times and increase efficiencies in hospitals, those are real world case studies of how AI can take big data and bring really meaningful results. And if you're going to be bringing AI to a lot of companies, the upstart, there's always going to be room for new upstarts. But if you're large organizations and you want to incorporate AI, it's not like the internet era where it at first was just a website. If you're going to have something with your data, you want someone you can trust, someone who can get the right insights. You want someone at Palantir scale to pull that off. So I think they have a big opportunity. They're already showing how they're extracting real value from using AI. And another tailwind, which is, it's not always what you want to see, but, going back to, what's going on around you in the world, the Peter Lynch theory, see what you see in front of you. If you look at the kind of Russian-Ukrainian war, so much of that has become like this drone warfare.
Oh, yeah.
And Palantir has just signed some recent contracts with the U.S. Defense Department. If you listen to the CEO, I mean, he's very cognizant about which countries are even allowed to use their software for defense purposes. So, I mean, if you have a software that's in such demand that you can choose who your customers are going to be, think of, race, Ferrari. That's a good example of someone who gets to choose who their customers are. That really signals that you have a product that brings value. And so again, looking forward, I think Palantir has its fingers on both kind of consumer applications and defense applications. And I think, again, if you look at that war and how it's become kind of like a drone war and everything that everyone's developing, AI is going to be needed for defense and consumer. So I think Palantir is touching multiple themes. I think it's caught up a little bit in terms of the valuation, which was a little bit over hot at the IPO. And also, I think just AI is starting to grow in a more mature way where they can finally now, kick off on new trends and lead that space. Whereas maybe that was still a newer concept even 3 or 4 years ago. So I think Palantir, and again, in terms of relative strength, you're seeing this is leading now. This is still sitting near its highs, whereas stocks like Nvidia have broken lower off of their highs.
Yeah. And this is one that really kind of seemed like it got a lot of institutional following very, very early on. It was just not that this matters that much, but I'll share with you that one of the things for a while there, if you wanted to write an article and you wanted it to get a lot of hits, Palantir was the clickbait. Like, I mean,
Right.
put Palantir in the name, and it didn't matter how bad the chart looked. You put Palantir in the name, and it was like your article's going to do okay, kind of thing. So
Well,
yeah,
to the point where it's that you almost don't want to bring up the symbol, but when you really see like a change of character, it's not bringing up the symbol just for the sake of the symbol. Whereas you can see like other times it was clearly lagging the general market. This is one versus NASDAQ versus AI names. Like, this is a bit holding up stronger now recently. So it's one to watch, as I do think they have like the potential here.
So in that regard, do you, again, because of its higher volatility, how do you kind of do your entry on something like that? And I'm asking for a friend.
You need to step lightly, and there's never really a perfect solution. But the way I build into all stocks is I never put on a full position all at once. I'll always, if I think it's a proper breakout, I'll start with a breakout, or Palantir. I bought this just recently on the pullback at around 30 and a quarter, just around $30 a couple of days ago. And so that's kind of like the first step in. If it's working and your profits are building, if this is going to be a big winner, you're going to have a lot of opportunity. So because the volatility is so high, I wait to get some profit cushion, then I use that to unlock the ability to add more money to the stock. Just kind of plunging aggressively in a stock like this can be a little bit more difficult. So that's kind of where a GEVs, where you can get a little more aggressive out of the gate with a stock like that versus a Palantir.
Yeah, and one of our listeners right now was mentioning that Joe Fahmy kind of said a similar thing. You mentioned Joe Fahmy earlier, and it was just basically like, yeah, if you're going to do more volatile stocks, like Palantir, you got to step lightly. You have to, start with smaller position sizes. And a few people were also mentioning that Palantir is one of the few stocks that have caused them to use foul language in regards to the stocks.
I just break keyboards. I have my closet. I have like a bunch of keyboards, take one out, plug it back in, and we're good to go.
Right. Okay. Well, hey, Matt, I got to say it's been a pleasure having you on. I really appreciate you being the guinea pig. It was great having the comments up here. I could kind of, check where people were at and what kind of things that they were looking at. So I really appreciate our audience that tuned in live. I appreciate the audience that's going to be looking at this at the archive version too. Next week, we're going to do this all over again with a live showing. We're going to try this a few times, see how this plays out. But Matt, really appreciate you coming on and joining me for this. Where can folks get more information? I know that you put some great stuff out on X. So please share your Twitter handle with folks.
Yeah, I'm trader_M Caruso. And there's also my website, CarusoInsights.com. We actually just relaunched this week with a mobile app and a whole bunch of new features, market alerts and all. So put a lot of work into that past few months, which I'm excited about. So plenty of information there as well in the resources section, free articles and just general thoughts.
And I should mention that, Matt, some of your videos that you've done, your educational videos are phenomenal. You were a finance professor for a while. Again, you already made the comment about how 70s, I wasn't even, around for that. That's history to me. But, you have a great professor mentality in terms of how you explain things, and it's something I really appreciate, and I've gained a lot of information from you. So thanks for sharing it with our listeners. Really appreciate you coming on, and thanks again for being my guinea pig.
Anytime, Justin. Thank you so much. I appreciate it.
Okay, that's going to wrap it up for us. This segment, this show. I'm used to doing segments typically, but thank you so much for watching. Next week, we're going to have Harold Morris, one of our senior market surge product coaches. He's going to be on. We're going to be doing it live again next week, so make sure you kind of mark on your calendar 5 p.m. Eastern, 2 o'clock Pacific. We can do this all again. I'm going to be watching in the comments, and yeah, we're going to have a good time. So Harold on next week. Arusha's going to be back a couple weeks after that. So he's a few people were asking about him. He's going to be back in a few weeks. And also don't forget to like and subscribe. That really helps us out and kind of lets us know that we're on the right tack here with these live streams. You can also get the archived version at www.investors.com/podcast and join the like and subscribe of the podcast venue that you prefer. So thanks a lot for watching this time around. We'll see you next week. Take care.